Two Nobel Prize winners broke their own trading rules and lost $4.6 billion in 4 months. If geniuses can't survive breaking their rules, you definitely can't. There's only one simple thing that separates consistently profitable traders from everyone else who eventually goes broke: having a system and following it with absolute discipline. Not 90% of the time, not most of the time, 100% of the time, or you might as well not have a system at all. Let me ask you this. Why do most retail traders lose money? Is it because they're stupid? No. Many losing traders are highly intelligent. Is it because they don't work hard? No. Most losing traders work incredibly hard, studying charts for hours every day. Is it because they don't know any profitable strategies? No. There are dozens of strategies that work, freely available on YouTube. So why do they lose? Because they don't have a system they follow religiously. Or they have one, but they break it whenever their emotions tell them to. Here's what most traders do. They learn a strategy. They test it a few times. Maybe they even see it work. Then they get into a real trade, money is on the line, and suddenly the rules go out the window. This time is different. I have more information now. My gut is telling me something. I'll just move my stop a little further. This is definitely going to reverse. And just like that, they're not following a system anymore. They're gambling. They're making decisions based on hope, fear, and ego instead of logic and probability. Think about how casinos operate. They don't win every hand. They don't win every spin of the roulette wheel. But over thousands of spins, over thousands of hands, their mathematical edge ensures they're profitable. The casino has a system. Pay out less than the true odds. Repeat indefinitely. And they never deviate from it. They don't look at a high roller and think, you know what? This guy's been losing a lot. Let's give him better odds to be nice. They don't get emotional after a big loss and change their payout structure to chase their money back. They follow their system robotically, mechanically, without emotion. And they always win in the long run. As a trader, you need to be the casino. Your system is your edge. Your discipline is what ensures you collect on that edge over time. But the moment you break your rules, the moment you make a discretionary decision based on feelings rather than your system, you become the gambler sitting across from the casino. And the gambler always loses. What a real trading system looks like. A real system isn't vague. It's not buy when it looks good or sell when you feel nervous. A real system has 4 non-negotiable pillars. 1. Entry rules, objective criteria that tell you exactly when to enter. No interpretación. No, it feels right. If X, Y, and Z conditions are met, you enter. If they're not, you don't. Period. 2. Exit rules. Both your profit targets and your stop losses defined before you enter. Not, I'll figure it out when I'm in the trade. You know exactly where you're getting out, win or lose, before you risk a single dollar. 3. Position sizing rules. A fixed percentage of your account at risk per trade. Not, I'll risk more when I'm confident. Same risk, same formula, every single trade. 4. Trade management rules. What you do while in the position. Do you trail stops? Take partial profits? These are decided in advance and followed mechanically. If you're missing even one of these pillars, you don't have a system. You have guidelines that you'll abandon the moment you're uncomfortable. And that's exactly when you need your system most. The LTCM disaster. Now let me tell you the most expensive story about breaking trading rules in history. Because if this doesn't convince you that nobody, not even Nobel Prize winning geniuses, can survive without following their rules, nothing will. The Dream Team. In 1994, a hedge fund was founded called Long-Term Capital Management. This was an Avengers-level, all-star team of the absolute best minds in finance. John Meriwether, the legendary former vice chairman of Salomon Brothers. Myron Scholes and Robert Merton, who would later win the Nobel Prize in economics for their options pricing model. David Mullins, former vice chairman of the Federal Reserve, plus a team of PhDs in mathematics, physics, and economics. These weren't gamblers. These were the smartest quantitative minds on the planet, using sophisticated mathematical models to identify tiny inefficiencies in global markets. And for the first few years, they were untouchable. In 1995, they returned 21% after fees. In 1996, they returned 41% after fees. In 1997, they returned 17% after fees. Banks were begging to invest with them. They had $4.8 billion under management. They were leveraged 25 to 1, controlling over $120 billion in positions. They were printing money using mathematical models that identified arbitrage opportunities, small price discrepancies between related securities that would eventually converge. Their system was built on Nobel Prize winning mathematics. It was backtested. It was sophisticated. It worked. But here's what's critical. Their system had rules. Risk management rules. Position sizing rules. Leverage limits. And in 1998, they broke those rules. The breakdown. In the summer of 1998, Russia defaulted on its debt. This triggered a global flight to quality. Investors panic-sold risky assets and bought safe assets like U.S. Treasury bonds. LTCM's models predicted that the spreads between different bonds would converge. They had taken massive positions betting on this convergence. But instead of converging, the spreads widened dramatically. Now, here's where it gets interesting. Their models said these dislocations were temporary. Their mathematics said the positions would eventually work out, and they were probably right about that. But they had broken their most important rule: position, sizing, and leverage limits. They were so confident in their models, so certain they were right, that they had taken on massive leverage, much more than their risk rules allowed. Some estimates put their leverage at over 50 to 1 by this point. When the spreads moved against them, they faced margin calls. They needed to post more collateral. But because they were so over-leveraged, they couldn't meet the calls without closing positions. And here's the death spiral. When they tried to close positions in a panic market, they pushed prices even further against themselves. Other hedge funds smelled blood and actively traded against LTCM's positions, making the situation worse. The collapse. In 4 months, from May to September 1998, long-term capital management lost $4.6 billion. Not because their system was wrong, not because their mathematics was flawed, not because they were stupid. They lost $4.6 billion because they broke their risk management rules. They were so confident, so certain they were smarter than the market, that they ignored their own position sizing limits. They used excessive leverage. They convinced themselves that this time is different, and that their genius-level understanding of the market meant they could bend their rules. The Federal Reserve had to orchestrate a $3.6 billion bailout involving 14 major financial institutions because LTCM's collapse threatened the entire global financial system. The lesson. Think about this. 2 Nobel Prize winners, former Fed vice chairman, the smartest quantitative minds in the world with a mathematically perfect system, destroyed because they trusted their judgment over their rules. If they can't survive breaking their rules, you definitely can't. This is the lesson. It doesn't matter how smart you are. It doesn't matter how much experience you have. It doesn't matter how good your system is. The moment you decide you're smart enough to override your rules, you're gambling. And in trading, gamblers always lose eventually. LTCM thought they could manage risk discretionarily because they were geniuses. They were wrong, and it cost them everything. What breaking your rules actually costs you. Let's talk about the real cost of rule breaking, because most traders think it's just about that one trade. It's not. The immediate cost. Sure, there's the money you lose on the trade itself. If you move your stop loss and the trade went further against you, that's real capital gone. If you over-leveraged because you were sure about a trade, you magnified your loss. If you entered without your full criteria being met, you took on risk without corresponding edge. That's the obvious cost, but it's actually the smallest cost. The psychological cost. This is where the real damage happens. When you break your rules and lose, you create confusion. Now you don't know if you lost because your system doesn't work or because you didn't follow it. You can't learn from the trade. You can't improve your system because you didn't actually trade your system. You traded your emotions disguised as discretion. When you break your rules and win, it's even worse. Because now you've reinforced the behavior. Your brain says, see, you were right to trust your gut over your rules. This is how discipline dies. Not in one dramatic moment, but in small victories that teach you the wrong lesson. The opportunity cost. Here's what most traders don't realize. Every trade you take outside your system isn't just risking capital. It's preventing you from taking legitimate trades within your system. You have limited capital. You have limited risk capacity per day or per week. You have limited emotional bandwidth. When you waste those resources on trades that break your rules, you're not available for the trades that fit your system perfectly. You're literally choosing low probability gambles over high probability system trades. The compounding cost. Remember, trading is a game of compounding edge over time. If your system has a 55% win rate with a 1.5 to 1 reward to risk ratio, you have a positive expectancy. Over 100 trades, you should be profitable. But if you only follow your system 70% of the time, and the other 30% are emotional trades with no edge, you've destroyed your positive expectancy. You don't get to cherry pick your way to profitability. You have to take every system trade and only system trades for your edge to compound. 1 or 2 rule breaks per week might not seem like much, but over months and years, they represent hundreds of trades where you had no edge. And those hundreds of trades eliminate any advantage your system provides. How to build unbreakable discipline. So how do you actually become the kind of trader who follows their rules with absolute consistency? It's not about willpower. Willpower fails under pressure. You need systems and structures that make rule following automatic. Step 1. Build trust through backtesting. You can't follow a system you don't trust. And you can't trust a system you haven't proven works. This means extensive backtesting, not testing it on 5 trades, testing it on hundreds of historical trades to establish that it has a genuine edge. When you've seen your system work over 300 backtested trades, it's much easier to trust it on trade 301 when your emotions are screaming at you to break the rules. Step 2. Forward test without real money. Once you've backtested, prove you can actually follow the rules on a demo account or paper trading. This isn't about proving the system works. You already did that in backtesting. This is about proving you can follow it. Most traders skip this step. They backtest, see the system works, then jump straight to live trading. And they immediately start breaking rules because they never built the habit of following them. Spend at least 50 trades in forward testing. If you break your rules even once, start over. The goal is to build a perfect track record of discipline before real money is involved. Step 3. Use pre-trade checklists. Before every trade, go through a physical checklist. Does this meet all my entry criteria? Is my stop loss placed exactly where my system says? Is my position size calculated per my risk rules? Have I written down my exit plan for both wins and losses? Am I emotionally neutral right now? Or am I trading from fear/greed/revenge? If you can't check every box, you don't take the trade. No exceptions. This checklist creates a pause. It interrupts the emotional impulse to just get in and forces you to confront whether you're actually following your system. Step 4. Journal your rule adherence, not just your P&L. Most traders journal their wins and losses. That's fine, but it's not the most important metric. You need to journal your discipline. After each trade, rate yourself. Did I follow my entry rules? Yes/no. Did I follow my exit rules? Yes/no. Did I follow my position sizing rules? Yes/no. Did I experience any emotional interference? Yes/no. Your goal is 100% yes on the first 3 and 100% no on the 4th. In the beginning, a losing trade where you followed every rule perfectly is a win, because you're building the habit that will make you profitable long-term. A winning trade where you broke your rules is a failure, because you reinforced a habit that will eventually destroy you. This is hard to accept. We're wired to care about money. But if you focus on discipline first, the money follows. If you focus on money first, you never develop the discipline. Step 5. Redefine success. You need to completely reframe what success means in trading. Success is not making money today, being right about market direction, catching the big move. Success is following your system perfectly for 100 trades in a row, taking every trade your system signals, no matter how you feel, sitting out every setup that doesn't meet your criteria, even when you know it'll work. When you redefine success as perfect execution rather than immediate profit, everything changes. You start measuring yourself by what you can control, your discipline, rather than what you can't, market movement. And paradoxically, this is exactly when you become profitable. Because consistent execution of a positive expectancy system guarantees profit over time. The identity shift. Here's the final piece. You need to change how you see yourself. You are not a trader who tries to follow rules. You are a system executor. Your job is not to outsmart the market. Your job is not to predict what happens next. Your job is not to be right. Your job is to flawlessly execute your system like a robot, without emotion, without deviation, without exception. Think about what this means. You don't make trading decisions. Your system makes decisions. You just execute them. You don't get credit for wins. Your system gets credit. You just follow the rules. You don't take responsibility for losses. Your system has losses built in. You just execute it properly. Your only job is to do exactly what your system tells you to do, exactly when it tells you to do it, with exactly the position size it specifies. This might sound limiting, like you're removing all skill and judgment from trading. But here's the truth. Your judgment is your enemy. Your intuition is unreliable. Your emotions are designed to protect you from tigers, not to make probabilistic decisions about financial markets. The only edge you have is your system. The only skill that matters is your ability to follow it. When you truly internalize this, when you stop seeing yourself as a trader and start seeing yourself as a system executor, everything gets easier. You stop negotiating with yourself. You stop second-guessing. You stop breaking rules. Because you're no longer asking, should I take this trade? You're asking, does my system say to take this trade? And that question has only one answer: yes or no. What sustainable profitability actually looks like. Let me paint you a picture of what actual sustainable profitability looks like in trading. Because it's not what most people imagine. It's not exciting. There's no adrenaline rush. It's not about big wins or being right about market calls. Sustainable profitability looks like this. You check your charts at the same time every day. Takes 15 minutes. You see 3 potential setups. Only one meets all your criteria. You take it. You place your stop and your target exactly where your system says. You close your laptop. The trade either wins or loses. You don't watch it. You don't stress about it. Your system already told you where to exit. At the end of the day, you journal the trade. You note that you followed your rules perfectly. That's all that matters. You repeat this for 100 trades. Your win rate is 54%. Your system predicted 55%. You're in the expected range. Over those 100 trades, you're up 18%. Not because you had genius insights or predicted the market, because you executed a positive expectancy system with perfect discipline. This is boring, and that's exactly the point. If your trading is exciting, you're doing it wrong. If you're getting emotional about trades, you're doing it wrong. If you're constantly analyzing and adjusting, you're doing it wrong. Profitable trading is mechanical, systematic, and repetitive. It's the same process over and over for months and years. The traders who make it aren't the ones with the highest IQ or the most complex strategies. They're the ones who can execute the same simple process with perfect consistency, even when it's boring, even when it's frustrating, even when every instinct tells them to do something different. Let's bring this full circle. Long-term capital management had the smartest people in finance, Nobel Prize winning mathematics, and a system that worked. They lost $4.6 billion because they broke their risk management rules. If they can't survive breaking their rules, you can't either. The uncomfortable truth is this: your trading system probably isn't your problem. Your inability to follow it is. Every time you break your rules, you're gambling. You're making decisions based on emotions, not probabilities. And gamblers always lose to the casino. You need to be the casino. Follow your edge religiously. Never deviate. Trust the mathematics over your feelings. This is hard. It's the hardest thing about trading. Not because following rules is complicated. It's because following rules when you don't want to requires a level of self-discipline most people never develop. But it's also simple. You either follow your system 100% of the time, or you don't have a system at all. There's no middle ground. So ask yourself, are you a system executor or are you a gambler? Because only one of those survives in this game.